Hey, what's going on, guys? I'm Dr. Boyce Watkins, and I am driving, so I'm not going to take too long in this video, but I wanted to share something about the Apple stock split that you may or may not know. And this plays a part in terms of why stock splits occur, why people love them, and the impact this has on the Dow, and why the Dow Jones Industrial Average doesn't mean what it used to mean after the Apple stock split. So here's the deal. Stock splits tend to happen because companies just want their shares to trade in a specific range. Investors tend to like stock splits because there's something that feels good about a price being lower than it was before. People like to buy whole shares instead of fractional shares because they have that availability. Historically, stock splits provided what they call liquidity because more people could afford your stock, but that's just not true anymore with these apps that allow you to buy, 1/1000th of a share, things like that. So anybody can own Amazon or Berkshire Hathaway, things like that, even though the share prices are in the thousands. Now, one interesting thing that media has tapped on a little bit, but something that you should understand is that a lot of people pay attention to the Dow Jones Industrial Average as a measure of how the stock market is doing, and the Dow has always been a flawed way to kind of look at how the market's doing. But even I have that bias. Even I pay attention to the Dow. But I think that the Apple stock split is a reminder that paying attention to the S&P 500 might be a better way to get an indicator of how the market's doing. But even then, the S&P doesn't include what's happening in the NASDAQ. That's why sometimes you'll see the NASDAQ do really well and the S&P won't do so well. You really want to understand the nature of the kinds of stocks that are in the index in order to determine whether the index is reflective of how well your portfolio is doing. So for example, if you own a lot of tech stocks, the NASDAQ matters to you more than the S&P 500. But if you own a lot of industrials, big Fortune 500 companies, then the S&P matters. And the reason I like the different indices that relate to the NASDAQ or to the S&P is because they tend to be value weighted, which makes sense, right? Which means you weight the company's presence in the index by how big the company is. So bigger companies have a bigger weight. The Dow does not work that way. The Dow, which was created many, many years ago, is price weighted, which doesn't make any sense from any sort of theoretical standpoint. It makes no sense to price weight an index, but the Dow is price weighted. So what happened when Apple split its stock is that the weight that Apple has in the Dow dropped. It drops by 4. A 4-to-1 stock split means that Apple now has 1/4 of the influence over the Dow that it did before. And given that Apple was one of the high flyers, one of the superstars of the market, one of the safe havens, Apple was pulling up the Dow. So now the Dow is not going to be pulled up as much because the other major weighted companies in the Dow, the companies that have the biggest weights in the Dow, are not doing as great as Apple. So you're going to see the Dow actually dip as a result of Apple doing the stock split. In fact, it may take a while before the Dow actually catches up to its previous high. But whether or not this impacts your portfolio or not is a matter of sort of looking at what you're invested in. So that's my 2 cents on the issue. If you want to learn more or get started for free on investing and get some free information, feel free to go to firstshareofstock.com. That's firstshareofstock.com. I'll send you lots of free stuff in your email that you can use to begin your journey to learn from the Black Business School. And I'm out of here, guys. Have a good day. I'll see you soon. Bye-bye.